My name's Ethan Braid. Today we're going to talk about using the 4% rule with REITs as your primary retirement investment. We're going to look at a 25-year illustration for someone who retired in the year 2000 with $1 million invested in the IYR ETF. The results for a retiree who used REITs as their primary investment vehicle over the last 25 years and the 4% rule as their distribution plan have been impressive to say the least. I started this illustration on the inception date of the IYR REIT index, June 12 of 2000, ran it all the way to the end of March this year, 2024. You start with $1 million, you take out $40,000 per year, grow that for inflation, and this graph is what your principal did. You started with $1 million, we're ending with $3.7 million. Really impressive. Far better than the stock market, the bond market, or balanced funds over the last 25 years. Let's dig into the numbers so we can see why REITs did so well over the last 25 years for the retiree who used them as their primary investment vehicle and used the 4% rule as their spending plan. We make our $1 million investment in June of the year 2000, and at the end of June, we take out $40,000. Then we grow that $40,000 every single year, every June, by 3% for inflation. Here is why this strategy works so well over the last 25 years. See this column here, total reinvest? Notice that in the first full year, which is 2001, this investment strategy paid $57,205 in dividends, i.e. income. The income was more than what the retiree was spending, which was $41,200. And notice further that every single year in this illustration, the income is greater than what the retiree is spending. By the year 2023, our annual distribution has grown to nearly $80,000, but our income is just over $100,000. Meanwhile, our principal is at $3.7 million. Since we've been earning more income than we've been spending the entire time, we've never had to touch our principal, and we've allowed our principal to grow over the last nearly 25 years. I think there are a couple big takeaways from this illustration. One, REITs were really cheap 25 years ago. If you had invested $1 million back in the year 2000, 2001, you were getting about a 6% yield, almost $60,000 a year of income. That was far more than the 4% rule needed, right? You're $40,000 in the first year, but you're earning close to 60. The problem now is that REITs are really expensive, right? You're getting much less in yield. You can't get over 4% on the REIT index now. The yield is much lower than that. So that's something to consider. When you look at this illustration, you think, wow, maybe I should just put all my money in REITs for retirement. Well, timing played a big role in this. Like I said, years ago, REITs were really cheap. They were attractively priced, and they've done really well in the last 25 years. There's been another driving force, and that has been declining interest rates. Remember that when interest rates go down, leveraged assets, i.e. REITs and bonds, go up in price. So declining interest rates over the last 20-some years really helped grow your REIT principal. Take a look at this graph. Here's a graph of the 10-year Treasury yield for the same time period as our illustration starting on June 12 of the year 2000. Notice the trend. Interest rates for the 10-year Treasury went down and down and down and down for roughly 20 years. Only recently have they come back up. The decline in interest rates over all these years was a serious force helping push REITs up in value and a major contributor to the growth of the principal in this illustration from 1 million to 3.7 million. Because of REITs going up so much in value over the last several decades, the current distribution yield on the IYR ETF is only 2.93%. Another way to think about this is that 25 years ago, $1 million investment in the IYR ETF got you about $60,000 in income. $1 million investment today only gets you about $30,000 in income. So whereas 25 years ago, you could employ the 4% rule very easily with the IYR ETF because you're earning 60 and spending 40. Now it's upside down. You have to spend some principal. You're only earning 30, but you're spending 40. And what that tells me is that REITs are still really overpriced. Even though they've come down, they're probably going to go lower in the future. Also consider that for a REIT to maintain favorable tax status and REIT classification, a REIT needs to distribute 90% of its income. So when I see the IYR REIT Index ETF distribution at 2.9%, it really makes me scratch my head and say, wow, is that the best that they can do? If the REITs in the index are distributing 90% of their income, they're either not making very much or the more likely case, the real case, it's just very expensive. Under more normal market conditions, I would expect to see at least a 5 or a 6, maybe a 7% distribution. When you're distributing the bulk of your profit, then you would expect as an investor the bulk of your return to come from the distribution. It just so happens that the last several decades, we got tremendous appreciation, a tailwind on REITs from declining interest rates. I think in the future, we're going to see an adjustment. I wouldn't expect as much appreciation over, say, the next 20, 25 years, and I would expect an increase in income and maybe some price depreciation in the years ahead while we get to a more normal distribution for REITs in general as they adjust to higher interest rates. REITs can definitely play a role in a retirement portfolio going forward, but I would be more critical of cash flow and expect less in terms of appreciation from any REITs or REIT indexes that I was investing in. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments and overall improve your family's financial plan.